Hello everyone, welcome to Fearfully Greedy. In today's episode, I wanted to talk to you about RYSAS, a company that has become quite popular in the YouTube finance sphere. And first, and as always, the purpose is to learn more about the subject. That's all the videos, or I'm trying to do so. And second, to share some of what I learned with you. So I hope that's helpful to everyone. And I saw some people a bit lost with it, me included, so why not? So what's RYSAS? RYSAS is a Turkish company listed in the Istanbul Stock Exchange under ticker RYSAS. The company engages in multiple segments, so the structure of the business is that of a holding company. So it owns and operates independent business in different fields. Some do have synergies, some do not. We'll touch a bit more on that later. But those segments are real estate, logistics, vehicle inspection, tobacco, and hotel administration. Remember, these and all my videos are not to be considered financial advice. Please consult a professional or do your own research before investing. The story of the business starts in 1989 or 1990, depends who you ask, and it started as just a logistics company, the one that has trucks, some vehicles, some small vans. That's a bit of what I got. No railway, no nothing. And then after 30 years, it has evolved into much more. Now it is reigned by or leader by a father and a son duet that is running the show. And according to Manish Pabrai, they are a real deal, like great compounders. I wish I could give you a bit more about the story, but honestly, I haven't translated some old Turkish newspapers and I couldn't get much more. And there's a limit of how much I will spend on a tangent, so don't get me wrong. It is an important tangent. It's important. The story of the business tells us a lot about the culture, the nature of the business, but I wasn't getting much in this particular one, and they are a bit opaque when reporting, so this stays like this, a 2-point story, like where they started to where they are now. In future company analysis, I'd like to spend a good portion on the business history, but for this one, I don't have it. Sorry. I think a great way to understand a business is seeing how the money flows. I made this one with translated annual reports from the last years, so there was some digging to get these numbers. But what we see is roughly $100 million in revenues. Not too bad for a 130 million market cap company. Gross profit of roughly 30%. Great. And then we go to operating segment. Still very little expenses, over $31 million in operating profits. So the story looks bright, great. But then the story optically turns. We see $41 million in financing expenses from interest expense and currency loss. And you could say this is one-off or something like that, but not actually. So this is recurring as the eye can see. So we end up with a net loss of $5 million, and it's reduced in half by minority interest. So we don't own 100% of all the business. We'll get into that. To sum it up, we could be dealing with a good business that is quite leveraged, and we will need to peel the onion to get a clearer picture. Let's do so. Let's see what's on the books. We see 50 million in cash, 17 million of other short-term assets, making total current assets 67 million. On the other side of the fence, we see 109 million in current liabilities, making over 90% of that the portion of the long-term debt due in the next year. Or I'm guessing so by the standards. This could be refinanced or probably paid down in the next quarter's cash influxes. So it's not the end of the world, but not a sign of a business swimming in cash. Or that's my feeling. The rest of the liabilities are about $100 million in long-term debt, getting up to $218 million in total liabilities. For a business making $31 million in operating profits, that's a pretty penny, around 6 times that. I always compare earning power or assets when assessing liabilities, because in a vacuum it doesn't mean much. We have to see how much the business is making or what it owns to assess that. The $100 million of revenues from this $103 million in net property, plant, and equipment, it's a good amount, but I'm guessing this is mostly from the non-real estate business. And then it's those $123 million that we see in other long-term assets, which are mostly from the real estate business. I couldn't find the notes, so I'm guessing, but reading the independent reports from the real estate business, it tells a similar story. So that's how they are reporting there. So that's why I'm guessing, because if not, I would have no idea what those $123 million of other long-term assets. So I'm guessing it's real estate assets. We get to total assets of $298 million. No treasury stock, no retained earnings, which, if they were positive, it's a good sign of a business generating a lot of cash. The lack of them doesn't mean directly the contrary, but it's another piece of the puzzle. These $300 million in assets compared to the $280 million in liabilities leaves us with equity of roughly $80 million. But remember that, according to Monish, the assets of the real estate business are a bit understated, or they have much higher potential. That's a big part of the thesis, so we'll see that next. They own 61.94% of the real estate company, which actually is listed independently. Logistics 100%, vehicle inspections 75.48%, tobacco 99%, and for the hotel administration business, what I got is that it is inside the real estate business. So again, 61.94%. So now let's value them individually. The real estate business is actually listed independently on the Istanbul Stock Exchange under ticker RYGYO. It will be what we call a REIT. So if you are experienced with them, and since they report independently, it should be easy for you to value this. Still, I tend to value all the business the same way, by how much money they make and will make in the future, how much money they need and can be reinvested into the business, assets and liabilities they have on their name, and that's pretty much it. The business made last year $35 million, from which $30 million were operating profit. The same story happens here, where all the profit goes into financial expenses, mainly from servicing the $170 million it owes. That's what we call, or we would call, some people would do it, operating leverage. But remember, the more you have it, the riskier it becomes. This $35 million in revenue is generated with $420 million of assets in the books. Not a crazy return, but I shouldn't be the one to tell you that real estate is an asset-heavy business. This business has some synergy with the logistics one, so that's a plus. And in my opinion, it's the highest quality business in the holding. By my rough DCF valuation, this is worth 3.5 times the market cap. We'll see this might be a better investment than the holding, but maybe we then have some governance issues, I'm guessing. That's why Monish might have sold its shares, because originally he held shares both on the holding and the REIT, making his exposure to the REIT even higher. The reason could be that he wants to be part of all the father and son adventures. He has said in interviews that he estimates the liquidation value of the assets at $50 square feet. Recently, he has gone higher and says that they are worth at least $800 million. If we want to take out the debt, we end up with $630 million, which compared to the market cap, it's very undervalued, even more than my estimate. Assets for the REIT have grown tremendously since 2009, which is very impressive, and my feeling is that they are actually very high quality ones. This growth is supported by high debt, as we can see, so we just need to be sensitive about that. Income and earnings are following, and I expect it to grow as the Turkish infrastructure keeps developing. The second largest segment in RYSAS is its logistics operations, transporting cargo by land, sea, and air by all kinds of vehicles. This business has roughly $40 million of revenues and makes an operating profit of $5 million. Still, it has some debt close to $50 million. This business is a high capex and very low margin one. It tends to be very stable and can take a lot of cash if wanted to expand operations, so it can actually grow a lot. It also has some synergy with all the holdings business, so that should be taken into account, right? Some synergy inside the group is very positive. A new development here is that this year they issued some shares, virtually doubling their shares outstanding to finance the direct European railway connection from Turkey. A very rough valuation of the business for me is $35 million, and it has great long-term potential. Next up is the vehicle inspection for road approval business. I'm sure it's a business that you have dealt with directly or know a bit what I'm talking about. At least here in Spain, you go through that every few years, depending on how old is your vehicle. And here also we have the public ones and the privatized ones, like this one. The business does $30 million in revenues, $1 million in profits. It also has some debt, so like $4 million in debt. It is a very low margin business, but at the same time, it's low capex. So you don't have to put a lot of money in the business. It's hard to grow by a lot, and it has a little synergy with some other business, like the logistics one. A very rough valuation for the business for me is $13 million, and it has very limited potential, in my opinion. In the fourth place, we find the tobacco distributing company, although it's impossible for me to imagine the exact current situation of tobacco consumption in Turkey. To me, it is very clear that globally we're in a downward trend. It is a very low margin, low capex business with a slight synergy with the warehouse and logistics segment. A very rough valuation of the business for me is $2 million. It's hard for me to think I'd pay more. Lastly, hotel administration. They acquired most of the business in 2018, and it operates as of now 2 assets of the real estate segment. It has had virtually no reporting up to this point, and the ones we have had are very abnormal due to the current global tourism situation. So with all of this said, I just can't value it. They did $1 million in revenue, and in the last year they made a $500,000 loss on that. Well, let's add all this up. We have 62% of a real estate business, which I value at $480 million. We have 100% of a logistics business at $35 million. We have 75% of a vehicle inspection business at $13 million, 99% of a tobacco business at $2 million, and 62% of a hotel administration, which honestly I can't value. If I run the math, I get to $344 million business valuation after debt, trading at $130 million. So the margin of safety is quite wide. If I'm right, which is a big if, you will see that for all business I have taken a bit of a low valuation. This due the balance sheet risk, the fair market risk, and some other risks that we'll discuss a bit in the end. Your valuation could also be different, and it should be that way. Always do your own work. I could even be wrong about some of the ownership structures here, so please do your own due diligence. If we check the EBITDA earnings graph, indeed, we see it pointing directly to the moon. Someone might say that EBITDA is the acronym for bullshit earnings. I hope you know who would say that. But there's one more caveat. If we adjust for currency, the story is quite different. The Turkish lira has lost roughly 90% of its value versus the dollar in the last 13 years, and they have covered currency, but it hasn't worked great. Then the other thing is that they actually operate in Turkish lira, so that part they can't do much about it. This doesn't happen in a vacuum. These people have been getting screwed by global macro currency economics, and when we put $1 into the business, we can be pretty sure that the outcome of that dollar down the line will be affected by it. In what way? I don't know. 9 years ago, I see return on assets of 9%, and they have improved to 12% in 2020. This is significant and a great improvement of the business. But still, those are somewhat modest returns on assets compared to other business. And remember, debt has put this on steroids, so it's not unlevered. It is an asset-heavy model after all. Like, as you know, most of it is real estate. For long-term compounding, it's still great. This business can take big dollars amount to reinvest for growth. That's key. Let's talk valuation. DCFs are loved here on YouTube, as you may have seen, and help make a video. But the truth is we should compare earning outlooks of different investments and keep discarding them until we find the best ones. At least is what I do. I have a long list of many business. I put a bit their earnings profile, and then I compare between them. But then there's also risk, but that's a bit more down the line, right? Knowing what we would pay for it is also valuable, but it's not the answer to the question. It's just one parameter. RYSAS is relatively cheap at this point. All things considered, it's trading at 4 times EBITDA, which actually I never use EBITDA, but the valuation is warranted. It's highly leveraged and debt is 6 times EBITDA. That trading multiple is quite common. When Monish got in at $20 million valuation, it was a no-brainer. Now it's cheap, but with growth potential. That's something we don't find a lot of the times with this valuation. So I guess that's what interested Monish in the first place. Some people might say that GYO, the REIT, is making a lot of money. Like if we check net income, you will see that the amount is quite big. Well, it actually comes from asset depreciation. So buildings or assets that they have bought, they have appreciated over time, I guess from some standardized way of valuing them. And then they get a high net income from that. And of course, they could keep swinging home runs and developing these assets in this great way, from worthless to worthy. But I don't know about that long term. It could be that their mode is buying great real estate that is undervalued. I don't know. I'm just firing some ideas. I don't have an educated guess at this point because I can't get to the documents easily and they have very few notes. So to understand them, it's tough. It's tough to see why this depreciation is happening. If it's them doing something great, like accommodating the warehouses, getting clients interested, developing the area. I don't know. I just can't guess. At the end, I have some red flags, doubts, thoughts, so I'm not trying to scare anyone. As you know, I just share my journey and what I think and learn. So my doubts are my reality, not yours. I find for RYSAS that the management is a bit opaque to foreign retail investors. They don't go all the way to try to inform you, so that's a bit of a red flag for me. The currency depreciation, as we have covered, 90% in the last 13 years, it's also like a huge risk for me. The high debt and leverage, another one. I don't love this super high debt. Other than the real estate business, the other ones to me don't look that amazing. And the farm market, it's a very far market for me. From me, I don't know anything about Turkey. I have been there, but what? I didn't learn a lot about business there. And without Monish, it would be a clear pass. With Monish in it, for me, it stays a pass. For now, I mean, I will keep learning about it, try to understand it, try to be better investor and see what he sees. But for now, I just cannot get in. So I haven't invested in RYSAS so far. That doesn't mean I won't in the future, but for now, it stays a pass. Now I will give you an update to the channel's portfolio. If you are new here, I share a public portfolio where I add some cash each month, and the story of the channel is my journey with it. Since the last video, I haven't done any trades, but the portfolio has appreciated quite a bit. But now I'm sitting on a 4,600 euro gain, or almost 21% on total appreciation, which if we money weighted, it's close to 27% annualized. Last month, I didn't add any cash to the portfolio. We should be back to normal transfer from now on. You can also check all the trades and details on the Google Sheet. It's linked in the description. Or you can also follow me on Twitter. I usually post there first thing when I buy something or sell something or do any big moves on the portfolio. So stay tuned there. If not, the Excel, I will update it also there. With that, I will leave the video here. I will continue my quest for some value picks. It's hard work, so wish me luck, but I will be back when I have something to share. Thank you for watching. Stay safe. Take care.